Good morning. On behalf of Sikich LLP, welcome to our complimentary governmental accounting and financial reporting series of webinars. My name is Fred Lance, and I'm a partner in charge of government services here at Sikich, and I'm going to be one of your moderators for today's webinar. At Sikich, we believe our best client is the best educated client, and we provide a wealth of seminars, webinars, and other educational opportunities to help advance your knowledge and your skill set. Today's topics are two of the recent pronouncements issued by the Governmental Accounting Standards Board. First, we will cover GASB Statement Number 72 on fair value measurement and application. This may impact how we determine the fair value of certain assets that we hold, especially if we have a trusted pension plan or OPEB plan that has expanded investment authority and expanded investment options from what we see at most general purpose governments. In addition, GASB Statement 72 will certainly add to our already lengthy note disclosures related to overall cash and investments. The second pronouncement that we will cover today is GASB Statement Number 79, Certain External Investment Pools and Pool Participants. Statement 79, which was just released in January of 2016, provides guidance on how certain external investment pools, such as the Illinois Funds, Illinois Metropolitan Investment Trust, or the Wisconsin Local Government Investment Pool, will be valued by both the pool members and the pool participants and the pool itself. We're going to have to look and see whether or not we can maintain our $1 net asset value per share to account for these, or will we have a floating net asset value for these pools in the future. And again, like all GASB pronouncements, we'll have some additional note disclosures regarding our participation in these overall investment pools. Our primary instructor today is Mark DeVries, Director of Government Services in our Wisconsin office. Mark has over 20 years of experience in the state and local government industry, serving governments of all shapes and sizes, from some of the largest cities, counties, school districts, and special districts in the country to some of the smallest in the country as well. Mark took a few years off from his career in public accounting and was a finance director for a medium-sized county, similar to what some of you all are doing today, where he implemented a new ERP system, prepared an award-winning budget, and an award-winning comprehensive annual financial report, and like most of us, had to deal with declining revenue streams and workforce reductions without impacting service levels to constituents. Very, very challenging environment. So I'm going to go ahead and turn things over to Mark, and Mark's going to kick us off now with our first topic of discussion, which is GASB Statement Number 72.
Thank you, Fred, for that handoff. GASB Statement Number 72 deals with fair value measurement and application. It addresses accounting and financial reporting related to fair value measurements. There have been a number of statements that have dealt with fair value measurement, most notably Statement 25, which was the first pension statement, or what I think is now the old pension statement, because we should all be on 67 and 68 by now. Also, Statement 31 dealt with required investments to be carried at fair market value. Statement 34 dealt with presentation of changes in fair value. Statement 40 dealt with disclosures regarding risks related to investments. And Statement 53 dealt with our favorite topic of derivatives. The reason 72 came about is because there were some conflicts between this existing guidance and some lack of guidance for specific areas, and also recent economic events that have placed a renewed focus on fair value measurement. The Financial Accounting Standards Board and the International Accounting Standards Board have already issued related standards, and so GASB is now following suit with Statement 72. Statement 72 was released a little over a year ago in February 2015 and is effective for reporting periods beginning after June 15th of 2015. So our June 30, 2016 year ends will be the first to see the implementation of GASB Statement 72, and everybody will follow suit from there on. So the application of Statement 72 applies to investments, and I think that before we go much further, we should look at what the definition of investments is. The definition of investments is found in the summary of the statement if you're reading Statement 72. And there are also a number of examples of investments found in the illustration 4 in the appendix of the statement. The definition of investments according to Statement 72 is a security or other asset that a government holds primarily for the purpose of income or profit and has a present service capacity based solely on its ability to generate cash or to be sold to generate cash. Now, there are a number of new topics introduced in Statement 72, and some of them will seem like they're very common sense type of concepts. But I think that more and more what we're seeing, especially in the industry and and on Wall Street is a lack of common sense. And so I think what the GASB decided was to make sure that everybody understands what these concepts means. And so they've defined them very narrowly. And so there isn't much room for interpretation when it comes to Statement 72. The rules are very explicit. So the application of Statement 72 is determined by the intended use of the asset at the time of purchase. Statement 72 introduces the concept of service capacity. The concept of service capacity focuses on intended use. If the intended use of the asset is to generate cash or to be sold to generate cash, then Statement 72 defines that asset as an investment, and this statement applies to that asset. Capital assets, on the other hand, are typically not intended to generate cash directly. Most capital assets are used to provide services. Their present service capacity is based on their ability to provide direct services, not their ability to generate cash. This is why capital assets are not accounted for using fair value measurement principle. Capital assets are typically purchased with the intent, or if a capital asset is purchased with the intent to be sold at a later date, then that capital asset would be considered to be investment under Statement 72. So if an asset is held for resale at a later time, then this statement would apply to that asset. The next slide goes through some potential investments that are affected by Statement 72. The first is alternative investments that are reported by endowments or pension funds. Now, the three basic kinds of investments are common stock, debt, and equity and mutual funds. Alternative investments are investments such as hedge funds, managed futures, real estate, commodity, and derivative contracts. The second type of potential investment that would be affected by Statement 72 are equity securities. These are stock warrants, stock rights, common stock that do not have readily determinable fair values. Intangible assets that meet the proposed definition of investments are also affected by this statement, as are land and land rights, including oil and gas properties, commingled investment pools that are not government sponsored, invested securities lending collateral, real estate meeting the definition of an investment asset, life settlement contracts when there is no insurable interest. The purpose of the instrument is solely to generate cash and should be measured at fair value. Debt securities reported as assets, regardless of whether they meet the definition of investments or they were acquired or originated by the government, and securitized debt obligations. So I know we have representatives from several different states listening today. The good news is that many local governments are restricted by state statute as to what they are legally allowed to invest in. Most investments allowed by state statute have readily determinable market values, so the impact of implementing Statement 72 will be limited to an additional paragraph or two in the footnotes. However, government pension plans could be greatly affected by the new disclosure requirements. We've got some examples of the new disclosures later on in this presentation that we'll be going through. There are a number of investments that are not affected by Statement 72. Investments in non-participating interest-earning investment contracts are valued using the cost-based measure. Investments in unallocated insurance contracts should be reported as interest-earning investment contracts according to the provisions of Statement 31 or Statement 59. Money market investments and participating interest-earning investment contracts that have remaining maturity at the time of purchase of 1 year or less are held by governments other than external investment pools are reported at amortized cost. Investments held by 2A7 external investment pools are also held at amortized cost. Now, I think it's important to talk a little bit about what a 2A7 pool is. A 2A7 pool is a pool that's regulated by the SEC. Later on, we're going to talk a little bit about Statement 79, which was drafted as a response to changes that were made to the rules, the SEC rules back in 2014, and that take effect in April of 2016. So when we talk about 2A7 like pools in this presentation, that also pertains to external government-sponsored investment pools that we'll discuss later on. So a 2A7-like pool is an external investment pool that is not registered with the SEC as an investment company, but nevertheless has a policy that will operate in a manner consistent with SEC Rule 2A7 and allows money market mutual funds to use amortized cost to report net assets. The reason why Rule 2A7 was established is it was intended to make money market funds more resilient by increasing portfolio diversification and also limiting the type of investments allowed to be purchased by the pool to first-tier securities. Examples of these pools are the Local Government Investment Pool in Wisconsin, the Iowa Public Agency Investment Trust in Iowa. I know we've got some people from Iowa listening in this morning, and also the Illinois funds in Illinois. Fred, are there any others you can think of?
There's the Illinois Metropolitan Investment Trust here in Illinois that also would probably be impacted by that. In the school district side, we see a variety of school district liquid asset trusts now that are established as 2A7-like pools. And for some park districts and other special districts, we see some pools also established for them. So I think we really need to search for, or look far and wide as to the impact of this in the future and how it might impact that dollar per share net asset values.
So fair value was first defined in Statement 31 back in 1996, I want to say. Sound about right?
Mm-hmm.
Statement 31 defined fair value as the amount at which an investment could be exchanged in the current transaction between willing parties other than in a forced or liquidation sale. Statement 72 has superseded this definition and now defines fair value as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Again, we're seeing the introduction of a couple new concepts here. The first is an orderly transaction. The second is the transfer of a liability, which hasn't been dealt with in previous statements. The term market-based assumes that all potential buyers are equal. Fair value is a market-based measurement. Fair value is not entity-specific. However, adjustments to fair value are entity-specific. What not entity-specific means is that fair value begins with a broad definition and from there is adjusted for specific traits of the transaction. The traits of the seller are not considered. The traits of the transaction are. And we'll get into that and what that means a little bit later. For instance, a motivated seller would typically drive down the selling price of an investment in order to gain time. Fair value does not consider a motivated seller to be a transaction trait. It is an entity-specific trait. That's the difference between entity-specific and transaction-specific. Now let's talk a little bit about orderly transactions. The definition of an orderly transaction is a transaction that assumes exposure to the market for a period before the measurement date to allow for marketing activities that are usual and customary for a transaction involving such assets or liabilities. It's not a forced transaction. The indications that a transaction is not orderly are probably easier to define than a transaction that is orderly. So some of the indications that a transaction may not be orderly is the period of exposure to the market before the measurement date was not adequate to allow for customary marketing activities. The asset or liability was only marketed to a single participant. We have a distressed seller or a forced sale, or the price is an outlier when compared to other recent transactions for similar assets or liabilities. Orderly transactions are assumed to exist at the measurement date. That is, it's important to note that these sales are assumed to be happening at the measurement date. Statement 72 now introduces the concept of markets. A fair value measurement assumes that a transaction to sell an asset or liability takes place in either the principal market, which is preferred, or the most advantageous market. The principal market is defined as the market with the greatest volume or level of activity. The most advantageous market is determined after taking into consideration transaction cost and transportation cost. Transaction costs are the cost to sell an asset or transfer a liability in the principal market, or the most advantageous market that are directly attributed to the disposal of the asset or liability and that result directly from the transaction and that would not have been incurred if the decision to dispose had not been made. Transportation costs are just exactly that. They are the cost to transport an asset. In determining the most advantageous market, these two types of costs are considered. Again, when pricing the asset, these costs are not considered. Governments should have access to the market at the measurement date, whether it's the principal market or the most advantageous market. Access does not necessarily mean being able to sell. It just means that they can access the market that they're using to value the asset. Because this is an assumed transaction, the market should be considered from the perspective of the government, allowing for differences between and among entities with different activities. The reason why it's considered from the perspective of the government instead of the perspective of the seller is because in the seller's eyes, you may offer less than what the government may be willing to accept for the transaction. So one example of a principal market would be, for instance, an auto dealership. If we think about selling a car, a principal market for obtaining a car would be to go to an auto dealership and buying a car. Now, if the car that you're looking for is not at the dealership, maybe the year has expired in which you're, for the car that you're looking for, you may go to another market, a secondary market, which would be your most advantageous market, which may be a private person. That's the difference between the principal market and the most advantageous market. Market participants. Fair value is based on assumptions that market participants would use in pricing the asset or liability. We assume that market participants would act in their own best interest. The reason why, again, this seems like a very common sense principle, but there may be cases where a market participant would not act in their own best interest. In cases of charity, perhaps the seller feels charitable towards the buyer, or perhaps the buyer feels charitable towards the seller. Because we need to define very narrowly these concepts, GASB has told us that all parties are going to act in their own best interest. That's the assumption. It's not necessary to identify specific market participants. It's just assumed that they exist. The measurement of fair value is developed in the context of an assumed transaction in which the absence of observable market transactions does not limit the ability of a government to determine the exit price that market participants would determine. So the absence of similar transactions does not preclude the assumption that the asset could be sold as of the measurement date. Another new concept under Statement 72 is the concept of unit of account. Unit of account addresses the question, at what level should the fair market measurement be made? So there may be one single asset or liability or several assets or liabilities that are grouped together in a transaction. The measurement, recognition, or disclosure of an asset or liability, whether a single asset or liability as a group, depends on the unit of account of the asset. Sometimes unit of account is defined by accounting standards. For instance, the unit of account for investments in a brokerage account is each individual security, whereas the unit of account for a mutual fund is each share of government owns in the fund. Another example of this is a limited partnership. A government that owns an interest in a limited partnership rather than an interest in each individual asset and liability in a limited partnership. So in some cases, these assets are going to be grouped together, and accounting standards will define whether or not they're grouped. However, in other cases, it may be subject to what the intent of the seller is. For example, a very simple example of unit of account could be if a government purchases one large piece of property and intends to parcel it out into several smaller pieces of property and sell to individual buyers. That will have an impact on the price because obviously the sale to individual buyers as opposed to sale to a developer of a large parcel of property will be greater. So when one considers the unit of account in measuring fair value, you should Also look at the intent if where the government accounting standards are silent. Now we're going to talk about considerations on pricing. Some of the considerations that we use when we're pricing an asset is the condition or location of the asset. And I think it's important to note at this time that the condition or location of the seller is not considered when pricing the asset. The condition or location of the asset is considered. Restrictions on the sale or use of the asset that are characteristics of the asset and not the owner are also considered. Earlier when we defined fair value, we discussed how the traits of the seller do not enter into the pricing considerations, only the traits of the transaction. However, certain traits of a transaction are exempt from consideration. These include transaction costs, such as sales tax and transportation costs. The reason these are not considered is because we have not identified a specific market participant. Further, the government could engineer a transaction in such a way that such costs would be negated. So price should not be adjusted for transaction cost. Remember when we said earlier that transaction and transportation costs are used to determine the most advantageous market? This is the only time these costs are considered. Now we're going to talk about valuation and the types of valuation techniques as defined by Statement 72. The government should use valuation techniques that are appropriate under the circumstances. We can use one or more techniques that are defined by Statement 72. The techniques that are most appropriate are the ones that will maximize the use of observable inputs, or inputs that are used to develop market data, such as publicly available information about actual events or transactions, and which reflect the assumptions that market participants would use when pricing an asset or liability. We should minimize the use of unobservable inputs, which are inputs for which market data are not available, and that are developed using the best information available about the assumptions that market participants would use when pricing an asset or liability. Again, this is common sense. So there are three approaches that are defined by Statement 72 to measuring fair value. The first is the marketing approach, the second is the cost approach, and the third is the income approach. In most cases, a single valuation approach will be sufficient. The approach that you use should be consistent from period to period. Revisions to valuation techniques should be treated as a change in accounting estimate. So once you've established a valuation technique, it should be consistent from year to year. If you change techniques, it's treated as a change in accounting estimate, with the change being flowed through the current year. Each valuation technique can have various inputs. The strength of an input is defined by its level in the fair value hierarchy. We'll first discuss the various valuation techniques and then discuss the hierarchy of inputs. The first valuation technique we'll discuss is the market approach. The market approach uses prices and other information generated by market transactions involving identical or similar assets and liabilities. The multiple markets techniques uses multiples or ratios derived from identical or similar assets, such as price to earnings or market to book value. The matrix pricing technique is used to value some types of financial instruments, such as debt securities, without relying exclusively on quoted prices. You'll see this most often used in corporate bonds and municipal bonds.
Why would that be used in municipal bonds, Mark?
Because municipal bonds aren't normally publicly traded from day to day.
That's an excellent point. So even though that we register our bonds and we issue them with the DTC, and we assume that they're traded on a daily basis, as you noted, they might not be. So what would a matrix pricing technique do in that instance?
It would help establish a baseline by relying on securities relationships to other benchmark quoted securities.
So generally what that will do then is, if we don't have a specific price for our specific security that day, what a matrix would do is it would look at what are other comparable, similarly rated general obligation bonds with a similar maturity and a similar stated interest rate selling for on that particular date, and then develop a matrix from that to come up with a price for our specific bond set. Is that how that would work?
Exactly.
Would that also apply to treasury obligations and agency obligations?
No, because they're traded on the market on a daily basis.
Great.
So this is the approach that will be used by most local governments. We've got an example of this approach at the end of this section, the S-72 section that we'll go through. The next valuation technique is the cost approach. The cost approach reflects the replacement cost of the asset or the amount that would be required to replace the present service capacity of the asset. This is from the perspective of the seller. The price would be that would be received for the asset based on the cost to a market participant buyer to acquire or construct a substitute asset of comparable utility, which is also adjusted for obsolescence. The third valuation technique is the income approach. The income approach converts future amounts to a current amount, such as future cash flows, and it reflects current market expectations about future amounts. There are several different valuation techniques. We can use present value techniques, which is the present value of future expected cash flows, option pricing model technique, which is a valuation technique used to value an option contract that is based on the critical terms of the contract and implied volatility. Multi-period excess earnings technique, which is a valuation technique based on prospective financial information associated with the collection of assets. The initial amount is reduced for the contributions of supporting assets, with the residual amount being the excess earnings associated with the asset being valued. A government should select inputs that are consistent with the characteristics of the asset or liability that market participants would take into account in a transaction for the asset or liability. Premiums or discounts that reflect size as a characteristic of a government's holding are not permitted in the measurement of fair value because this is a seller-specific trait. Again, we're looking only at the traits of the asset, not the traits of the seller. If an asset or liability measured at fair value has a bid price and an ask price, for example, an input from a dealer market, the price within the bid-ask spread that is most representative of fair value under the circumstances should be used to measure the fair value, regardless of where the input is categorized within the fair value hierarchy. Now we're going to talk about the fair value hierarchy. The fair value hierarchy deals with inputs into the valuation of an asset. There are three inputs that we're going to talk about: level 1 inputs, level 2 inputs, and level 3 inputs. Level 1 inputs are the inputs that we're typically going to use the most frequently. Level 2 inputs are inputs that will be used occasionally for most governments, even if you are restricted by state statute, because these are more typically, as we noted earlier, typically used in association with valuing debt securities such as corporate bonds and municipal bonds. Level 1 inputs are quoted market prices for identical assets or liabilities that a government can access at the measurement date. These would typically be quotes from sources such as Yahoo Finance, the Wall Street Journal, and publicly traded equities. Level 2 inputs are inputs that are observable for an asset or liability either directly or indirectly, and deal with inputs that for similar assets instead of identical assets. So the difference between level 1 and level 2 is that level 1 deals with inputs for inputs for identical assets that are traded publicly. Level 2 deals with inputs from similar assets that are not identical but similar. Level 3 inputs are unobservable inputs. If the fair value of an asset or liability is measured using inputs from more than one level of the fair value hierarchy, the measurement is considered to be based on the lowest priority level input that is significant to the entire measurement. So we're using the conservative principle here. So let's give an example. If there are 3 inputs significant to a certain fair value measurement, and 2 of them are level 2 inputs, and 1 is a level 3 input, the fair value measurement will be categorized in the footnotes as a level 3 input in the fair value hierarchy for disclosure purposes. Assessing the significance of a particular input to the entire measurement requires professional judgment, taking into account factors specific to the asset or liability. So level 1 inputs are quoted prices for identical assets or liabilities in an active market. This market provides the most reliable evidence of a level 1 input of fair value and should be used to measure fair value without adjustment whenever available. The emphasis within level 1 is on determining both of the following: the asset and liabilities principal market, whether the government can enter into a transaction for an asset or liability at the measurement date, or do we have access to the principal market. Level 2 inputs are quoted prices for similar assets or liabilities in similar markets. They can be quoted prices for identical or similar assets in markets that are not active, inputs that are other than quoted prices and that are observable at commonly quoted intervals, such as interest rates and yield curves observable at commonly quoted intervals, implied volatilities, credit spreads, and market corroborated inputs. Adjustments to level 2 inputs can include condition or location of an asset to the extent which assets are comparable and the volume or level of activity in the market. There are a number of examples of level 2 inputs in the illustrations in the back of the Statement 72. A couple of these are, again, municipal bonds, corporate bonds, variable interest rate swaps, that are based on the LIBOR rate, valuation multiples such as multiple of earnings or revenue derived from observable market data. Level 3 inputs are developed using the best information available under the circumstances and may include the government's own data. Level 3 inputs should only be used when relevant level 1 or level 2 data inputs are not available. The government should take into account all information about market participant assumptions that is readily available. A measurement that does not include an adjustment for risk would not represent a fair value measurement if market participants would include one when pricing an asset or liability. Examples of assets using level 3 inputs would be something like commercial real estate. These valuations are typically developed using the government's own data. Another example is long-dated currency swap, or interest rate in a specific currency that is not observable and cannot be corroborated by observable market data at commonly quoted intervals. The interest rates in a currency swap are swap rates calculated from the respective country's yield curves. We would not expect to see many level 3 inputs being used for most governments.
What would you think an example would be, Mark, where we would use a level 3 input for a government?
This will probably most commonly occur in pension funds that aren't regulated.
Pension funds that aren't regulated, or perhaps if you have a entity with an active tax increment financing district or TID district where they're acquiring property for resale and they intend to resell that at a profit as opposed to for economic development purposes. That would also, having to value that at fair value, I think would be a level 3 input, and a challenging level 3 input at that. So.
Yeah.
We did get one question come in, Mark. If you want, we can try and address this now.
Sure.
It goes back to the question of trying to differentiate between a capital asset and an investment. And we said at the start that the definition of a capital asset that might be at fair value is if it's used solely to generate a profit or to generate income. And the question was, this is someone who has an airport authority, and they said the airport authority owns passenger terminals and hangars that yield lease income because they lease those to the airlines to generate cash. Would that be considered an asset that would be reported at fair value, or would that more be a capital asset to be reported at cost or amortized cost?
That's an asset that is a capital asset. That is not an investment.
Okay. Even though it generates income, but the primary purpose of it is not to generate cash, it's to provide that service of transportation. So.
Yep, that's the reason why it's a capital asset, right?
Okay, so the same would hold true then if we applied that to, say, governments that provide water services or sewer services, the water treatment facility or the sewer treatment plant, while they generate income and generate cash flows, aren't primarily used for that purpose. They're primarily used to provide services to constituents. So that's why we classify those as a capital asset as well. So
the primary purpose is to provide services.
okay.
That's the intent, and not to generate a profit or revenue. Even though the generation of profit or revenue comes from the capital asset, it's really intended to provide services to the public.
Super. As opposed to, say, a capital asset or land that was purchased for economic development purposes.
Right.
If it's for economic development, that may be a service. However, if it's held for resale or for profit, then we classify that as an investment.
Yep.
Super.
I think another good example of that may be something like a tax foreclosure. So if you hold a parcel of land because you foreclosed on it because someone hasn't paid the property taxes, those are not investments as defined by Statement 72 because they came as a result of a foreclosure process. You were never intended to hold those as investments.
Great example. Thanks, Mark.
Back to the use of quoted prices. Quoted prices provided by third parties such as pricing services or brokers may be used if a government has determined that the quoted prices provided by those parties are developed in accordance with the provision of the statement. If there's been a significant decrease in the volume or level of activity for an asset or liability, a government should evaluate whether the quoted prices provided are developed using current information that reflects orderly transactions or a valuation technique that reflects market participant assumptions. So I guess what we're trying to say here is that just because you found a quoted price doesn't not necessarily mean that that can be used as an input to determine fair value. There are other things that need to be considered when using quoted prices, such as volume of activity. If the volume of activity has decreased, that may indicate that the fair market value of your asset has also decreased. There may not be as much of a market as when the quoted price was obtained. Here's another concept that's introduced by Statement 72. It's highest and best use, and it's another common sense concept. Highest and best use simply means that an asset's ability to generate the most resources in a way that is physically possible, legally permissible, and financially feasible. If an accounting standard requires the application of fair value to a non-financial asset, for instance, real property, the fair value measurement takes into account a market participant's ability to generate resources by using the asset according to its highest and best use, or by selling it to another market participant that would use the asset according to its highest and best use. Typically, the highest and best use is the asset's intended use. Here's a very simple example of highest and best use. If I purchase a dump truck that I expect to use as a dump truck, then that is the highest and best use of the dump truck. If I purchase a dump truck that doesn't have an engine, its highest and best use might be scrap metal.
And what if you put a plow on the front end of that dump truck, Mark? That would be the highest and best use of that dump truck.
Well, it's still scrap metal if it doesn't have an engine. So a use that is physically possible takes into account the physical characteristics of an asset that market participants would take into account when pricing the asset. So it's not physically possible to operate a dump truck without an engine. A use that is legally permissible takes into account any legal restrictions on the use of an asset that market participants would take into account when pricing an asset. For example, the current zoning regulations applicable to a property would be a legal restriction. A use that is financially feasible takes into account whether the use of an asset that is physically possible and legally permissible generates resources, taking into account the cost of converting the asset to that use. To produce an investment return that market participants would require from an investment in an asset put to that use. So the highest and best use is determined from the perspective of market participants using relevant market data as of the measurement date, even if a government intends a different use for the non-financial asset. So in other words, back to our dump truck example, if you're buying it, if it's a fully operational and functional dump truck, but you're buying it for scrap metal, not sure why you would do that, but this is just an example, you still have to value that according to its highest and best use, which would be using it as a dump truck. So here's another new concept that's introduced by Statement 72. is the transfer of liabilities and valuing liabilities at their fair market value. The measurement of the fair market value of a liability assumes that the liability is transferred to a market participant at the measurement date. An example of this is an interest rate swap that's in a liability position to a government. We see more and more of these lately, which is why we're responding to this in Statement 72. The transfer of a liability assumes that the liability would remain outstanding and that the market participant transferee would be required to fulfill the obligation. If a quoted price for the transfer of an identical or similar liability is not available and the identical item is held by another party as an asset, a government should measure the fair value of liability from the perspective of a market participant that holds the identical item as an asset as of the measurement date. Adjustments to this value should be made if there are factors specific to the asset that are not applicable to the fair value measurement of the liability. For instance, restrictions that prevent the sale, credit quality of the issuer, and the risk of non-performance. Changes in fair value are recognized in accordance with Statement 31. According to Statement 31, all investment income, including changes in fair value of investments, should be recognized as revenue in the operating statement or other statement of activities. When identified separately as an element of investment income, the change in fair value of investments should be captioned net increase or decrease in the fair value of investments. Generally, realized gains and losses should not be displayed separately from the net increase in fair value of investments in the financial statements. However, you can separate them in the notes if you'd like to. Equity interest in common stock. Here's a little twist in Statement 72. The default valuation for common stock is going to be the equity method, unless the equity method does not apply. That can be found in Statement 62. So equity interest in common stock should be accounted for using the equity method if they meet the criteria in paragraphs 205 through 208 of Statement 62. The equity method of accounting for an investment in common stock should be followed by a government whose investment in voting stock gives it the ability to exercise significant influence over operating and financial policies of an investee, even though the government holds 50% or less of the voting stock. And that's what Statement 62 says, is that you can hold less than a majority of interest in the common stock, but still have the ability to influence the policies of that entity. In that case, you are going to use the equity method of valuation as opposed to market values that may be readily available and quoted. This isn't going to happen very often, but I think it's noteworthy to point out. Investments in common stock that don't qualify for the equity method and that do have readily determinable market values should be recorded at the readily determinable market value. So most common stock investments are going to use market value. Now, the following investments are excluded from using the equity method of accounting. Common stocks that's held by external investment pools, pension or other post-employment benefit plans, Internal Revenue Code Section 457 deferred comp plans, or endowments or permanent funds. So those common stock that's held by any of those is going to be excluded from the equity method of accounting. We're going to go straight to fair value. Investments in certain entities that calculate the net asset value per share or its equivalent as provided in paragraph Statement 71 through 74 of Statement 72 are also going to be excluded. And equity interest in ownership in joint ventures or component units as provided in Statement 14 are also going to be excluded from the equity method.
So Mark, what if we had an equity interest in, say, an insurance pool? Would we mark that to a fair value?
Well, that would depend. If we have an equity interest in insurance pool, no, we don't mark that to fair value.
Right.
The excess or loss of that pool, the allocation goes to a line item on the financial statements that's called investment or deposit in the insurance pool.
Great. So if we have a dividend declared by an insurance pool and we haven't yet collected that dividend, we just need that the value of the dividend as opposed to trying to assess some fair value of it.
That's correct.
Great.
Typically as a receivable, dividend receivable.
Great.
Okay, what we're going to disclose in the statements, we've got a footnote example following next, is the fair value measurement at the end of the reporting period, the level of the fair value hierarchy within the fair value measurements that are categorized in their entirety, excluding any investments measured at net asset value, a description of the valuation techniques used in the fair value measurement, and if there's been a change in valuation technique that has a significant impact on the result, then you will disclose that change and the reasons why you made the change. So going back to the second point here, the level in the fair value hierarchy is going to be the lowest level at which the inputs are determined. So in other words, if you've got two different levels of inputs, you're using the lowest one. So level 3, if you're using the level 2 inputs and level 3 inputs, we're going to disclose in the footnotes that level 3 inputs are used to determine fair value.
And likewise, if we had a debt security that we used a level 1 and a level 2 input for, we'd have to disclose that then as a level 2 input. Again, going with that philosophy, the lowest level of inputs. So.
Yep. And also the description of the valuation techniques. Remember, there are several different valuation techniques. There's the market value, there's the cost value, and then there's the income value. So here's an illustration of the disclosure. This comes directly from the guidance. And we're just going to show you this one. This is the one that's most typically going to be used for all those governments that are restricted by state statute and what they can invest in. There is another an example of this disclosure that relates to pension investments in the statement. You can look up in the statement. It's available online at the GASB website. So you can see in the very first paragraph where we talk about level 1 inputs, level 2 inputs, and level 3 inputs. That's where we're describing the various levels of inputs for the reader in order to help the reader determine what these different levels mean. Then we go on to say what the fair market value measurements are and the different levels of inputs that we used to determine those fair market value. So in the first instance, the U.S. Treasury securities were using level 1 inputs because those are traded publicly every day on the market, and those quoted prices are available. In the second case, we're seeing corporate bonds of $12 million that are valued using a matrix pricing model, similar to what we discussed earlier. Again, municipal bonds are typically going to fall under this category of level 2 inputs, and we'll typically use a matrix pricing model as well. The third example, where the city has a non-recurring fair value measurement as of June 30 for a closed performing arts hall that will no longer be used and therefore is considered to be impaired. So it looks like they're getting ready to sell this thing, so they're holding on to it as an investment. And because they don't have a readily determinable market value, they're using level 3 inputs, which are probably something from their assessor's office, or maybe another government's assessor's office, or maybe an appraiser.
Great. We did get another question come in, Mark, and that question is, GASB statement number 31 provided an exception to fair value reporting based on a time period. And specifically, GASB statement 31 said if you had a participating interest earning investment contract, meaning like a debt security, where the fair value of that changed based on a change in interest rates, did we have to account for all of those at fair value, or did we have a 1-year exemption? And statement 31 did provide us that 1-year exemption. It said as long as the participating investment contract had a maturity at the time we purchased it of 1 year or less, we could keep that at cost or amortized cost, and we're not required to report that at fair value. Does that same exemption or option exist under statement 72 for governments?
Yes, it does. That's correct.
Good. So statement 72 did not preempt or supersede that component of GASB statement 31 that allowed us to keep these certain investments at cost or amortized cost. So that is still in effect. So for those of you that do have a policy where you account for certain investments that have a maturity in certain investments in participating investment contracts that have a maturity less than 1 year at the time we purchased them, can be then kept at cost or amortized cost, and we would not need to disclose any inputs or fair value related to those then. Great, thank you all for that question. We greatly appreciate the questions. If there's no other questions, then Mark, shall we turn our attention to GASB Statement 79?
Let's do it. Okay, GASB Statement 79 was very recently issued in December of 2015. It's effective for reporting periods beginning after June 15, 2015. So most of our June 30, 2016 year ends are going to be adopting GASB Statement 79. Except for provisions on portfolio quality, custodial credit risk, and shadow pricing, which are effective for periods beginning after December 15, 2015.
Shadow pricing, Mark, that doesn't sound very good. Is that something we need to be aware of?
It is. So governments pool their cash together in external investment pools to benefit from economies of scale and professional fund management, which is the whole reason why external investment pools are established in the first place. And because of recent changes in the SEC rules that will take effect in April 2016, GASB's issued a response to that as Statement 79, and it establishes criteria for an external investment pool to qualify for making an election to measure all of its investments at amortized cost for financial reporting purposes. An election that was previously established under previous standards as 2A7-like pools. If the pool does not meet the qualifications established by Statement 79, it values its investments according to provision of Statement 31. This statement also establishes additional note disclosures for qualified investment pools that measure all of their investments at amortized cost, and it's effective for reporting periods beginning after June 15, 2015.
What would a new GASB pronouncement be without some additional note disclosures for us, Mark?
Okay. Again, previous statements, such as Statement 31 and Statement 59, reference the Securities and Exchange Commission Rule 2A7 in relation to its guidance and provide guidance on 2A7-like pools. And because the SEC is changing its rules and changed them back in 2014 to take effect in April 2016, we need to do away with this nomenclature of Rule 2A7-like pools, because we're no longer going to follow Rule 2A7 anymore. So we initiated the research on the effect of the new changes that many existing 2A7-like pools would, what we determined is that a lot of them are going to have difficulty following the new rules. So that's the whole purpose behind Statement 79, is to move away from the SEC 2A7-like definition and move on to external investment pools that are defined by GASB statements.
So generally, Mark, if our Wisconsin local government investment pool meets these criteria, it can maintain its shares at $1, or it can maintain its investments at cost or amortized cost, and maintain $1 per share net asset value.
That's correct.
If, however, it doesn't meet the criteria that we're going through, then it would have to record its investments possibly at fair value, which would then mean it would have probably a floating net asset value as opposed to $1 per share net asset value.
That's right. And guess which statement we're going to follow for that? Statement 72 that we just went over.
Isn't that great the way GASB ties these two pronouncements together for us?
Okay. So the Statement 79 establishes accounting and financial reporting standards for qualifying external investment pools. So an external investment pool is defined as an arrangement that commingles the monies of more than one legally separate entity and invests on the participants' behalf in an investment portfolio. One or more of the participants is not a part of the sponsor's reporting entity. There are several different statements that this statement supersedes. Statement number 31, Statement 40, Statement 59, and parts of Statement 72 that we just went over, and the National Council on Government Accounting, NCGA Interpretation 6. So Statement 79 establishes various criteria for the pool to report investments at cost or amortized cost. These criteria must be met in order to report at amortized cost. Transactions executed with participants at a stable net asset value, and for example, $1, as Fred just mentioned. You must meet portfolio maturity requirements. You must meet portfolio quality requirements. You must meet portfolio diversification requirements. You must meet portfolio liquidity requirements. And you must meet shadow pricing requirements.
So Mark, for that first one, when it notes transactions executed with participants at a stable net asset value, that means when we buy shares throughout the year and when we liquidate or pull money out, that it's all being done at that dollar per share net asset value.
That's correct.
Okay.
So the maturity requirements that we just talked about in the previous slide, our maturity at the time of purchase of any security is at most 1 year plus 2 days. The weighted average maturity of the portfolio is 60 days or less. The weighted average life is less than 120 days.
Those are interesting requirements. So in the first, you can't have any security in the portfolio, any single security that at the time of purchase has maturity greater than 1 year and 2 days.
That's correct.
So if you purchased a treasury bill with or a treasury note with a 2-year maturity, that automatically would bounce you out of that.
That disqualifies you. Yep.
Just one single investment, regardless of the dollar amount of that investment.
Yep, and then you go back to Statement 31. The quality requirements are acquired securities denominated in U.S. currency, the highest category of short-term credit ratings by a nationally recognized rating agency, and the securities can continue to, or the pool can continue to hold a security that initially met the credit quality requirement but experienced a subsequent decline. Again, very similar to the current rules of SEC 2A7. The diversification requirements are no more than 5% of portfolio in any one user. This excludes U.S. Treasury and certain agency securities and insured certificates of deposit. This includes securities underlying repurchase agreements.
So again, if we had securities underlying a repurchase agreement, and a lot of times those securities will vary. If we have in our portfolio other securities and then we have these securities that underlie the repurchase agreement, we'd have to aggregate them all together from a single issuer or any one issuer and still meet that 5% threshold then. And if we exceed that 5% threshold, again, we're bounced out. We're bounced out of the box and we're no longer at cost or amortized cost or a dollar per share net asset value. Okay? So there's some pretty stringent requirements that GASB's come up with in Statement 79.
We also have liquidity requirements. No illiquid investments can exceed 5% and cannot be sold at cost or amortized cost within 5 business days. 10% of the portfolio must be held in daily liquid assets, and 30% of the portfolio must be held in weekly liquid assets, or a maturity in 5 business days.
Interesting that they define that as 5 business days or less, especially with the global investing that we have nowadays. They've structured that really, well, again, a very, very narrow standpoint.
The shadow pricing requirements are shadow price is a net asset value per share on a full fair value basis measured at least monthly. Shadow price cannot deviate greater than 0.5% or 0.5% from the net asset value measured at cost or amortized cost. Well, I want to thank you all for participating in this webinar. Our contact information is on the slides here in case you have any follow-up questions. And you can feel free to contact either Fred or myself with follow-up questions. Again, we've enjoyed putting on this presentation for you this morning. I hope you all learned a little bit and got something out of it. I think the most useful part of it is going to be the footnote disclosure, and I think that just about everybody is going to be affected by this. If you hold debt securities, this is going to affect you. So I think this footnote that's been included in the slides is going to be good for you to use as a template for future disclosures. This is, again, effective for June 30, 2016 year ends and beyond, both of these pronouncements. And so hopefully this comes in handy and is useful to you all. And thank you very much today. We'll open it up for any questions that you have now, so feel free to send us questions. We've got a few more minutes left in the presentation, so we can take questions.
We did get one question, Mark, and the question was, I'm not sure if it's a question or a comment, it said, we would like to discuss Statement 79 in greater detail. What we'd recommend, if you'd like to discuss 79 in greater detail than what we provided for this morning, shoot either Mark an email or shoot myself an email, and we'll be happy to expound a little bit further on some of the finer points and some of the finer requirements of GASB Statement 79, especially if you're with one of the investment pools and are looking at possibly challenging how to implement some of this from the investment pool standpoint. We're approaching it primarily from the local government's participation standpoint, but the majority of this really is written towards the investment pool and the requirements of the investment pool itself. So yes, please follow up with us with an email, and we'll get back to you on response to any detailed questions you have on Statement 79. So 79 is a very, very unique topic. As Mark noted, it's because of the SEC changes and GASB wanting to decouple those SEC changes with fair value reporting for us all, especially when we look at the extent of use of some of these money market accounts that we see by the state and local government industry and how to value those. So,
You have another question?
yes, we do. I'm just struggling to read it a little bit. I apologize. I need to get my glasses on a little bit better. I work as an accountant for a local government who is implementing these changes. Who makes these changes? The auditors, the investors, or the actuaries? Interesting question.
Well, who implements the standards is going to be the government. You know, as auditors, we issue an opinion on the fair presentation of your financial statements. We can certainly assist you with implementing the standard. Feel free to contact us with questions. What I would say about that is the sooner the better. If you have questions on implementing this statement, then what we would rather see is asking questions now instead of at the end of the audit process when we're getting ready to release the statement. So if you are a government that prepares your own financial statements, you should be talking to your auditors right now about how to implement GASB 72, particularly if you have investments that fall into those level 2 and level 3 categories.
Also, Mark, I think for those governments that have an investment manager or an investment advisor, as well as an investment custodian, would you expect that the investment advisor, manager, and or custodian would start providing some of this information in terms of how they priced a government's portfolio? Because a lot of times the government is just relying on that custodian for the pricing of that overall portfolio.
Well, I would say I wouldn't be relying on them. I'd be talking to them right now about getting that information together for you. So you can't assume that they're going to know about the changes in the standards, and I think that a lot of governments do assume that your investment managers and your investment custodians are aware of these changes, but that's not always the case. So being proactive, again, I think that's the whole message here, is that be proactive with your investment brokers, your investment custodians, and your auditing firm about these new standards, and making sure that we're in a position to put this footnote together efficiently at the end of the audit process.
Great. We had another question come in. Wow, it looks like 79 is a pretty popular topic this morning, Mark.
Excellent.
The next question is on 79, again, we stated 79. We have an external investment pool, and it's not qualified under GASB Statement 79, so evidently it's not going to meet the definitions that we just went over now with GASB Statement 79. However, we report a floating net asset value, but allow participants to transact at $1 per share net asset value. It's kind of interesting if you have a floating net asset value, but allow participants to transact at $1 per share net asset value.
That is interesting.
How should participants report their investment in the pool under GASB 72 as well as GASB 79? Generally, if they don't meet the definition of Statement 79, then the participants in the pool would have to report their investments in the pool based on the fair value of the underlying securities within that pool, and those underlying securities would be valued in accordance with GASB 72 and likewise GASB Statement 31. So that's where that shadow pricing, I think, really comes into play also, and that look back for the overall value of the pool. But in that case, yes, the pool participants would not be able to account for that at $1 per share, even though they can have inflows and outflows at $1 per share. If that does not meet the definition, it does have that floating net asset value. Great questions. One thing I know is GASB has issued, upcoming in their latest implementation guide, they have about 40 questions in the new implementation guide that's being deliberated right now that will impact some of the concepts we talked about in Statement 72 this morning. They have not yet implemented or issued any implementation guidance related to 79. So we'll have to look for that probably in the 2017 implementation guide as opposed to the 2016 implementation guide. So keep an eye open for some additional guidance coming out of GASB with an implementation guide related to 79 in the future. So great. Well, if we don't have any other questions, that will conclude our seminar for today. Again, Mark and I greatly appreciate all of your participation. Since we did go for about an hour and 15 minutes, most CPE is measured in contact hours, and 50 minutes equates to a contact hour. So I believe we should qualify for 1.5 hours of continuing professional education based on the timer that gets set up when we record these. So if we did meet that 1 hour and 25 minutes of contact time, I'm sorry, 75 minutes of contact time, hour and a half of instruction, we will go ahead and give you that hour and a half of continuing professional education. So again, thank you all for your participation. We hope you have a great day, and we hope you found this to be a beneficial and educational seminar, and we look forward to your participation in the future.